Hello everyone, welcome to a lecture series of financial management. So today is lecture number 24. So in this today's lecture of a financial management, we are going to see what are the different sources of a financing working capital requirement, how a business organization or any business in the or any industry, how they can raise the funds by the different resources available in the market. So what are those that we are going to see in today's lecture. Also, we are going to see in today's lecture along with that what are the different we can say estimating of working capital requirement, how it is done in this in this sector. So how the estimation is done in the current sector of financial working management, it can be done, that we are going to see. So starting for a first point, the different sources of a financial working capital requirement, how it is done, that we are going to see first. So if you see the slide, so these five sources are there. So these sources are used to raise the fund by any organization or by any industry. Now if you see the first one, is what? A cash credit. So you are very much familiar with this term, cash credit, isn't it? So many of you are having the ATM card is there. Again, a credit cards are there. So many are using this kind of a thing, credit card. So what is the function of credit card? So we use some amount of money. We can purchase, by using that money we can purchase a different entities of our daily requirement, and after the particular for a particular period of a time, and within that particular period of a time, one has to again refund that money to that bank. And if it is not possible, then what happen? The company, it will pay a what we can say, it will pay an interest on that credit, what the money we have taken, isn't it? So that is one kind of a thing that generally everyone is using. So if you see this credit card, cash credit, so it is generally, it is an arrangement by which the customer is allowed to borrow the money up to the fixed limit against some security, isn't it? So for fixed limit of a time, some fixed amount, it is borrowed by a customer, isn't it? So borrower can keep the property in his possession, or in case of any default in the payment of a dues or by the borrower, then bank can't impose a borrower some kind of an penalty, we can say, or some kind of an interest for due payment, isn't it? So such kind of a money, it is used for temporary purpose. It can be used for a temporary purpose by a borrower for a fixed uh, period of a time. And after finishing of this fixed period of a time, if the borrower, he doesn't return that money to the bank, then what happens? The bank imposes the penalty or some kind of an interest on that money, so that the borrower, he have to again pay that money to the bank. So this is one kind of an cash credit card that any organization or any industry, they can take the benefit of it to raise the funds. Now if you see the second one, is another type of a, or another mode of a money that one can raise, is it is called as an overdraft, isn't it? So an overdraft, again, it is one kind of facility which is provided by a banking sector or any financial sector to raise the fund. So overdraft, again, it is an temporary accommodation which is given by a bank, by which a borrower is allowed to overdraw his current account up to fixed limit. So we can say usually against the collateral securities such as you can say it is an hypothecation of marketable shares, stocks, or bonds. So what any borrower or any owner of that company, he can access his money from his current account. He can withdraw the some kind of a money from his current account for a temporary purpose to fulfill an emergency requirement of need of a money. And what kind of thing he can keep as a security? He can keep a stocks or some kind of a bond or some kind of a marketable shares. It can be it can be uh, it can be placed at the banking sector as an security purpose. So this system, it operates exactly on the similar basis just like an cash credit, isn't it? So but what is the main difference between this cash credit and overdraft? So only difference is that being that the overdraft is, it is an intended to be used for only temporary, whereas the cash credit is used regularly and for longer period of a time, isn't it? So overdraft, it can be used for temporary purpose, but this cash credit facility, it can be give the benefit generally for a regular purpose and for a longer period of a time. That means if I'm having a cash credit card of anyone's bank, then I can use that cash credit card for a 1 month, and within that 1 month, if I use that credit, if I use the balance from that card, then within that stipulated time, I have to return that money to the bank. And if it is not, then the bank will charge me some kind of a penalty. So after fulfilling that amount, in next month again I can use the credit card, isn't it? So it can go for a longer period of a time. Again next month, up to 12 month can use that credit card. So it can go for a longer period of a time. But that is not in the case for the overdraft. So in overdraft, what happens? It is used only for a temporary purpose, and it is withdrawn from a current account. Next one, again very popular thing, that one can raise the fund or capital, working capital, that is called as the loans, isn't it? So what is a loan? So loan, it is an arrangement by which the banker allows the borrower to withdraw some kind of a lump sum amount in full, and which is supposed to be repaid generally at one time. So you are very much familiar with this kind of a thing, that if any business organization, they can't run without loan, isn't it? So they have to take the loan from the bank. Obviously they have to fulfill all the legal entities, they have to fulfill all the legal formalities of the loan, and they have to keep some kind of a they have to show some kind of an asset to the bank to get that loan. So then and then only the bank, they can rely on that organization and industry, so that they can give the loan up to a they can give a loan of a big amount. So under such scheme, a borrower has to pay an interest for such kind of a lump sum amount in full for the contracted period. So some contracted periods are there for 1 year or 2 year. So within that contracted period, the borrower, he can take the loan from the bank, and in return he have to pay the interest, as the interest in may be a 10% or it may be a 12%. So based on that interest, they have to return that money to the bank. So loans are payable either on the demand or in periodical installment, and loan may be renewed for a further period also. So this thing is also there if anyone want to take a loan. So next one is discounting bill. So what is this discounting bill? So in this discounting bill, the bill of exchange is an instrument in writing the in writing the containing an unconditional order. So signed by the marker or directing a certain person to pay a certain sum of money only to or to the order of a certain person or the bearer of the instrument, isn't it? So when the holder of a bill want to get the money before the due date, then he can sell the bill to the bank against a small charge, so which is called as the discounting charge, and which is imposed by the bank at fixed rate percentage per annum, isn't it? So this bill of exchange, it is again one kind of a media that a person he can get some amount of money, some certain amount of money uh, after a due date, uh, and he have to again repay that money within that due period of a time, and he can get the benefit which is called as a discounting charge, isn't it? So by paying some discounting charge, he can get the benefit or he can raise the money. Last one is what? The letter of credit. So it is a document formally issued by a bank on behalf of its client. So client is nothing but the customer, isn't it? So on behalf of a customer, the document it has been issued by a bank, and it contains the condition under which the bank will act as a guarantor against the commitments and financial obligations of the customer. So it banks becomes the guarantee, they becomes the guarantor against the commitment and the final obligations of the customer. So as such the client, or you can say as such a customer of the bank, will face no difficulty in obtaining the loan from the suppliers. So it has been assumed to be also a most reliable method or reliable mode of raising the funds. So the bank, they shows the assurance, they should give some kind of an assurance uh, to to raise the funds for the customer. So any borrower or any customer, they can't face any kind of a difficulty to raise the fund. So that is called as a letter of credit. So on based on it is not an physical money, but based on the documentation which has been raised by a bank, based on that documentation, the customer or the client, they can get a money, because the here in this kind of a method, letter of credit, in this kind of a method, the bank itself is the guarantee for that customer. Next one is what? The estimation of working capital requirement. So this estimation of working capital requirement, here the excessive current assets result into a high amount of working capital. So this high amount of working capital, it ensures safety but at the cost of profitability. So it gives the safety as well as it gives the profit also. So on other hand, if the investment in current assets are reduced, then what will happen? It will lower the amount of working capital. So firm has to ensure a balance between two, and for this it is of paramount important to prepare an estimate of working capital. So estimation of working capital is of great importance if anyone who want to achieve a profit in organization. So statement showing estimate of working capital is also known as working capital budget. So the greatest advantage of preparing of the working capital budget is that it facilitates the planning of the level of holding current assets. So similarly, it also helps to compare the projected working capital and actual working capital. So there are the different steps. So by following these steps, one can estimate how this working capital can be how this working capital can be planned. So estimating a current assets. So in the prediction of working capital, it is estimated to predict the current assets. So current assets, it includes the few points. So first one is what? Stock of raw material, work in progress, and finished goods. Then any advance payment of the expenses, and then cash and bank balances. So all this comes under the category of estimating current assets. So these three major points are very important. What is that? First one, stock of raw material, then an advance payment of expenses, and last is cash and bank balances. So for predicting the level of inventories, it is necessary to calculate the expected holding period of each type of inventory or stock. So in case of debitors, or an average how much credit will be allowed to a debitor, it can be estimated. So for advance payment, it is necessary to estimate the amount that will have to be paid as advance. So as far as cash and bank balance is concerned, how much amount of the firm want to hold as a cash and bank balance, it should be estimated. So estimation of working capital is very important. Now if you see the second point, so in the second point, if you see the estimating the current liabilities. So second step in estimating the working capital requirement is to estimate the current liabilities. So current liabilities, it may include so many factors. So it may include the creditors. It may include the bill payable. It may include the bank overdrafts are there. Again, the expenses due but not paid and other short-term liabilities are there. So in estimating the creditors and bill payable, how much credit will be allowed by the creditor should be estimated carefully. So in case of other current liabilities, delay in payment of such liabilities, it should be estimated. So again, this is also a very important second point for estimating the working capital requirement. And last one is what? Contingency margins. So contingency margins, the difference between estimated current asset and estimated current liabilities will be the net working capital requirement. So to be on the safer side, a contingency margin, generally we can say of 10% to 50%, may be added into the net figure. So in addition to the above mentioned point, any proposed addition in fixed asset should also be taken into consideration if it is going to affect the working capital position. So similarly, how far changes in sales are going to affect the level of current asset, it should be taken into consideration. So these three important things are very important if anyone who want to estimate for a working capital requirement. Okay, so in this video or in this lecture, we have seen what are the different resources or different sources that one can have to raise the financing working capital requirement. How one can raise a capital, like a credit card is there, cash credit we can say. A second one we can see it is an overdraft. Third one it is a loan, and fourth one discounting bill, and last one is letter of credit. So by this five means one can raise a financial working capital requirement. And next one, what we have seen about what are the different estimating of working capital requirement. So estimating of working capital requirement, it is also known as what? Working capital budget, isn't it? So generally in the budget, working capital budget only, one can estimate how this can be this working capital requirement, it can be estimated by the means of what? Estimating current asset. So in estimating current asset, what you have seen, it includes the factor or assets like a stock of raw material or work in progress and finished goods also, and advance payment of expenses, cash and bank balances. So this thing, and again we have seen in estimating the current liabilities, there are the different factors like a trade creditors, bill payable, bank overdraft, expenses, expenses due but not paid and other short-term liabilities. So this main factor which is very important for estimating. And last one is what? Contingency margins. So the contingency margin, we can see it is of 10% to 50%. It may be added into a net figure. So these are the things that one have to take into a consideration while estimating. So today we will stop for this lecture. In next lecture we will see what are the concepts of cash management and what are its objective. Till then, thank you.